Picture this for a second. You're 64 years old, you've just retired, and you're sitting at your kitchen table with a cup of coffee that's gone cold because you've been staring at your investment statement for the last 20 minutes. And not in a good way, in a, wait, what do I actually do with this now kind of way. For 30 plus years, the plan was simple. Contribute, don't touch it, let it grow. But now the plan has to switch from build the pile to live off the pile without running out. And honestly, that's a completely different math problem, and almost nobody prepares you for it. I spend an unreasonable amount of time thinking about money, specifically about the weird gap between how we're taught to invest for 30 years and how little anyone teaches us about the next 30 after that. And a few months ago, I started noticing the same pattern showing up again and again in conversations with retirees, in forums, in comment sections, under retirement videos. This quiet little shift toward a particular ETF approach that almost nobody is talking about loudly, but more and more people seem to be doing. So, here's what I want to walk you through today. There's a strategy, not flashy, not some 10 times your money nonsense, that a growing number of retirees are using to simplify their portfolios, reduce stress, and actually sleep better at night. And by the end of this, you're going to understand not just what it is, but why it works, why it's quietly spreading, and whether it might make sense for you or for someone you love who's staring down that same cold cup of coffee. Sound good? Let's get into it. So here's the thing nobody really tells you. When you're working and saving, set it and forget it is genuinely great advice. You throw money into a couple of broad index funds, you ignore the noise, and time does the heavy lifting. But the second you retire, the second you start pulling money out instead of putting it in, that same strategy can quietly become a liability. Why? Because of something called sequence of returns risk. I know, that sounds like a guy in a suit says to make himself feel smart at a dinner party, but stick with me, because this concept alone explains why so many retirees are nervous, even when their portfolio should be enough on paper. Here's the simple version. Imagine two retirees, both with $1 million, both withdrawing the same amount each year. Retiree A retires right before a market boom. Retiree B retires right before a crash. Same starting balance, same withdrawal rate, same average return over 20 years, but retiree B can run out of money decades earlier than retiree A just because of the order the returns happened in. Not because they were less disciplined, not because they made worse choices, just bad timing. And that's terrifying, right? Because you can't control timing. You can't call up the universe and say, hey, can I retire during a bull market, please? It doesn't work that way. So, this is the emotional backdrop for everything we're about to talk about. Retirees aren't just thinking, how do I make my money grow? They're thinking, how do I protect myself from the one variable I cannot control when bad luck happens to show up? And that's exactly the itch this quiet ETF strategy scratches. All right, let's actually name the thing. What more and more retirees are doing is building what I'll call a two-bucket ETF core. And honestly, the simplicity of it is almost suspicious. It feels like it shouldn't work as well as it does. The structure usually looks something like this. One broad market equity ETF, something like a total U.S. stock market fund or a global all-cap fund, paired with one high-quality bond or fixed income ETF, often something short to intermediate duration. That's it. 2 funds, sometimes 3 if they split international exposure separately, but the bones of it are almost always this elegant 2-piece structure. Now, why is this spreading? A few reasons, and they're honestly kind of beautiful when you think about them. First, simplicity reduces panic. When the market drops 15% and your portfolio has like 11 different funds with overlapping holdings you can't fully explain, panic creeps in fast because you don't really understand what you own. But when your portfolio is, this fund is my growth engine, this fund is my stability cushion, and you can see that relationship clearly, you know which piece is doing which job. Second, it makes the bucket withdrawal strategy almost automatic. Here's how it tends to work in practice. The bond ETF acts like a holding tank. Maybe 2 to 5 years of living expenses sit there. When the market's doing well, retirees draw from the equity ETF and let the bond bucket refill itself through dividends, interest, or periodic rebalancing. When the market's down, they draw from the bond bucket instead and just let the equity side recover. No panic selling stocks at the bottom, no emotional decisions made at 11 p.m. scrolling through a falling portfolio. I want you to sit with that for a second, because this is the emotional core of the whole thing. It's not really about returns, it's about removing the decision from a moment when you're least equipped to make a good one. Because let's be honest, nobody makes great financial decisions while they're scared. The strategy basically takes your most stressed out future self and says, hey, don't worry, we already figured this out for you back when we were calm. And third, and this is the part that I think really explains why people quietly use it, it's tax efficient and low maintenance enough that people don't feel the need to talk about it constantly. There's no constant tinkering. No, did you hear about this new fund conversation at the dinner table? It just sits there doing its job, which honestly is the dream, right? The best financial strategies are often the most boring ones. If your portfolio were a person, this version of it would be the friend who never causes drama and somehow always has their life together. I want to push back on something for a second because I know what some of you are thinking. 2 funds, that's it? Isn't that kind of lazy? And look, I get the instinct. We're conditioned to think more complexity equals more sophistication equals better results. More funds, more strategies, more alternative investments. It feels like doing more. But here's the uncomfortable truth that took me way too long to internalize myself. Complexity is often just anxiety wearing a suit. Think about it from a different angle for a second. A chef who's truly mastered their craft can make an incredible meal from like 4 ingredients. It's the inexperienced cook who throws in 15 spices because they're not confident any single one is doing enough. The 2-fund ETF core is the 4-ingredient meal. It's not lazy. It's the result of someone asking, what's the simplest version of this that still does the job well, and actually having the confidence to stop there. And here's why this matters so much for retirees specifically. As we age, and I say this with total respect and a healthy dose of this will be me one day too, managing a complicated portfolio gets harder. Not because retirees are less capable, but because life gets busier in different ways. Health stuff comes up, family stuff comes up, and honestly, at some point, you might not be the one managing the money anymore. A spouse might, or an adult kid, or whoever you've designated. Imagine handing someone a portfolio with 18 positions versus handing them 2. Which one are they more likely to actually understand and manage well under stress? This is sometimes called the "can my spouse run this if I'm gone" test, and I think it's one of the most underrated questions in all of personal finance. It's not romantic, it's not exciting, but my goodness, is it important. A complicated portfolio that only one person fully understands isn't a strength, it's a hidden risk. The 2-fund core passes that test with flying colors. Anyone can look at it and go, okay, this part is for growth, this part is for safety. Got it. So yeah, simple isn't lazy. Simple is what's left after you've stripped away everything that was really just there to make you feel like you were doing more. It's called asset location, not to be confused with asset allocation, which is just about what you own. Asset location is about where you hold it, which account type each piece lives in. Here's the basic idea. Different accounts get taxed differently. A traditional IRA or 401k is taxed as ordinary income when you withdraw. A Roth IRA generally provides tax-free growth and withdrawals. A regular taxable brokerage account is taxed on dividends and capital gains as they happen, but often at more favorable rates, especially for long-term holdings. Now, here's the clever part. Bond ETFs tend to generate interest income that's taxed at your regular income tax rate. Not great. Equity ETFs, especially broad index ones, tend to be more tax efficient in taxable accounts because of lower turnover and qualified dividends. So what a lot of retirees using this two-fund approach are quietly doing is placing the bond ETF preferentially inside tax-advantaged accounts, like an IRA, where that interest income isn't creating an annual tax headache. And the equity ETF, especially in taxable brokerage accounts, just sits there compounding relatively tax efficiently, sometimes for years, without triggering much of a tax bill at all. Why does this matter so much? Because over a 20, 25, 30-year retirement, small percentage differences in tax drag compound into genuinely life-changing amounts of money. We're talking potentially tens of thousands of dollars over a retirement just from where you held the same two funds. Same strategy, same risk level, same everything. Just organized a little smarter behind the scenes. And this connects back to something that I think is honestly one of the most underused opportunities in all of retirement planning, and it pairs beautifully with this two-fund approach. It's called the Roth conversion window, and it exists because of a strange little quirk in how retirement income works. Picture this timeline. Someone retires at 62. Social Security doesn't kick in until 67, maybe even 70 if they delayed it. Required minimum distributions from traditional retirement accounts don't start until much later either. So for a handful of years, sometimes 5, 6, or 7 years, this person might have unusually low taxable income, like lower than almost any other period of their adult life. And during that window, converting some money from a traditional IRA into a Roth IRA can mean paying tax on that conversion at a much lower rate than they would later when Social Security and RMD stack up and push them into a higher bracket. It's basically like being at a buffet. Right now, during the slow period, the price per plate is really low. But later, once everyone else shows up, once Social Security and RMDs arrive at the table, the price per plate goes way up. The smart move is to fill your plate now while it's cheap, even if you don't need the food yet. A lot of retirees using this two-fund ETF approach pair it with these strategic conversions during that low income window, slowly moving money from the traditional bucket into the Roth bucket, a little each year, carefully staying under certain tax bracket thresholds. The result is less money subject to RMDs later, more tax-free growth in the Roth, and potentially a much lower lifetime tax bill overall, even though it might feel like they're choosing to pay tax now. It does require some attention. You can't fully set and forget this part, but it's not complicated tinkering either. It's more like an annual check-in. Once a year, look at the income picture, decide if there's room to convert a chunk without jumping brackets, and do it. That's basically it. Last piece, and honestly, this might be my favorite because it's so simple it almost feels like cheating. With a two-fund core, an equity ETF and a bond ETF, rebalancing becomes this incredibly calm, almost meditative annual task instead of some emotional roller coaster. Most people doing this well just pick a target, say 60% equity and 40% bonds, though obviously this varies a lot based on individual risk tolerance and timeline. And once a year, sometimes twice, they check. Has it drifted? If equities had a great year and now they're at 68% and 32%, they sell a little equity, buy a little bonds, and move to the target. If equities had a rough year and they're at 52% and 48%, they do the reverse. And here's the beautiful psychological trick hiding inside this. Rebalancing forces you to sell high and buy low automatically without having to predict anything or feel clever about timing the market. You're not trying to guess where things are headed, you're just maintaining a ratio. It's almost boring. And that's the whole point. Let's bring this all together. What we've really been talking about today isn't just buy these two ETFs and you're set. It's something deeper than that. It's about recognizing that retirement isn't really a finish line. It's a different game with different rules. And the skills that got you to the finish line, saving aggressively, picking individual investments, chasing growth, aren't necessarily the skills that serve you well once you're there. What serves you well in retirement is calm, clarity, and simplicity that holds up under stress. A plan you or your spouse or whoever's helping you can actually look at and understand on a hard day. And that's really why this quiet two-fund ETF approach, paired with thoughtful account placement and smart use of low-income years for conversions, has been spreading the way it has. It's not because it's exciting, it's because it works, quietly, consistently, without drama. And it gives people back something that's honestly priceless in retirement: the ability to stop thinking about money so much and start actually living the life all that saving was for in the first place. If there's one thing I gently encourage you to do, just take a look at your own portfolio. Not to overhaul it overnight, but to ask yourself, is this simple enough that someone I love could understand it on a hard day? And if the answer is no, maybe that's worth a closer look. Not because your way is wrong, but because you've worked hard enough for long enough. At some point, your money should start working a little quieter, so you can finally get a little louder about the things that actually matter.